For more on the bond market, let's bring in Jerome Schneider, head of short-term portfolio management at PIMCO. I sort of saw it this way too, Jerome. The market impact from Moody's relatively limited, but tells us once again, 37 trillion. Boom, nothing being done in terms of deficits this year, last year, next year. That on the one hand, so that's eroding the fiscal outlook. But bonds are cheap. But then right after you say that, bonds are cheap because there's growth concerns and inflation seems like it might be under control.
Yeah, for investors, they have to contextualize the conversation. Yes, we've been saying at PIMCO the fiscal outlook has been daunting for quite some time. Right. So the Moody's announcement was very limited in terms of practical implications. But for investors, rationalize the bond market right now. The income generation in the bond market is a positive. The real returns after inflation returns are about 2%. So even if inflation is a little bit higher than expected, bond investors should still get some expected real returns after that fact. And more importantly, the volatility, the growth uncertainty that is prevailing in the market, that's not necessarily going to leak into the bond market at this point in time. So the income generation available in the bond market is actually pretty exciting at this point in time, something we haven't seen in almost 2 decades. So put it in the big picture, it's a place to look, an island of tranquility amidst the volatility that's out there.
Growth concerns can be positive for interest rates, obviously,
right,
until they become, growth concerns turn into something worse, where then you start worrying about defaults and things like that.
Correct.
But as long as you don't get to that point, growth concerns can be a reason to own bonds.
Yeah, we're forecasting a recession probability of about 35% at PIMCO, and that's sort of come down over the past few weeks, clearly. But that real-time calibration suggests that there's not serial defaults. It's simply a slightly harder landing than expected, a low-growth environment. That should be expected. So right now, the calibration is a Fed that's probably going to be a little bit more pensive, a little bit more elongated in terms of cutting rates and adapting to the market. Inflation might be a little bit higher than expected than their target over the next year or two. That's to be expected. But at the same time, put it all together in terms of the risk opportunities. The bond market is really a place where you can look for assurances that in the front end, you can get 5 to 6% type of returns with high quality assets and diversified portfolios. It's not necessarily a place that has a lot of volatility given the broader market uncertainties with growth.
You still sound like you're saying, make me chase. Oh, bother, but just not today. Yeah, I mean, we got major problems, and no one in the right mind long term would want to be in fixed income.
We just spent a week talking about some of those major problems out in California, and those will not be resolved today or tomorrow. But in the longer term, we will have to deal with.
In the longer term, we're all dead?
Well, no, not necessarily. But we're going to see that start to be priced. Well, we haven't found the panacea.
None of us are getting out of here alive.
Right. So, but we are starting to see that being priced and rationalized in the market. So I don't want to be dismissive that markets are recalibrating in that sense. But we will have to take into account higher inflationary expectations. And the practical implication for most investors is let's rationalize what higher inflation rates do to overall portfolio allocations and prepare for those environments. What used to be a 0 to 2% inflation rate might be a 3 to 4% inflation rate. And so advisors, allocators...
Because of our problems at 37 trillion.
Well, we're structurally changing the economy in many ways.
When is the Fed going to cut?
So we forecast 2 rate cuts this year, beginning in September, and you probably have a little bit more elongated. There's factors that come in, obviously more data dependent, that perhaps push it until later this year.
Really?
And then when you get into 2026...
What would push it? Good growth or higher inflation?
The inflation factor is really important.
From tariffs?
And not necessarily just from tariffs, but you're seeing, again, the market or the economy recalibrate. It's not necessarily until you see job weakness and unemployment rates approaching 5% that you necessarily see the Fed come into action. And so that tension, that focus on inflation, the focus on price stability, Joe, is key and essential for the Fed.
So you said they will cut, so 5% is coming in unemployment this year?
No, not necessarily that quickly, but it's going to you're going to see an erosion in the job sector from robust job growth at 200,000 to something less than 100,000.
Okay.
So that will happen.